Welcome to the Deep Dive, the place where we turn massive stacks of research, financial reports, and stock screener data into clear, critical knowledge tailored just for you.
That's right.
Today, we are buckling up for a really comprehensive look into the highly dynamic auto manufacturing sector.
Yep. Our mission today is total signal extraction. We've synthesized recent news, technical trends, and the core financial metrics for really the three most talked about U.S. auto stocks.
So that's Tesla, the hypergrowth leader,
Ford, the legacy value powerhouse.
and RIVN, the high-risk, high-reward challenger.
Exactly. And we're going to be comparing three fundamentally different investment theses: growth, value, and, speculation all side by side.
We'll look at everything from their extreme valuation contrasts to these huge strategic pivots, like Ford's massive EV reversal.
And of course, the central role AI is playing in all their futures.
We're also running the paper money math, simulating a $5,000 investment niche from 3 months ago, just to see which one offered you the best ride.
And before we get started, just a necessary caution. Everything we discuss today is strictly for informational and educational purposes. It's all based on publicly available data.
Right.
So this deep dive does not constitute financial or investment advice. Always conduct your own thorough research.
Okay, let's unpack this sector, starting with the undisputed behemoth, Tesla, ticker TSLA. When we look at the data, the scale is just staggering. They recently closed at a new record high of $489.88.
And that commands a market capitalization north of $1.6 trillion. It's immense.
It is.
And you have to realize, when analyzing Tesla, the market just doesn't view them as a car company anymore. They're indexed as a tech and AI company.
Right, and that recent strength, up over 10% in just the last week, that's all fueled by that autonomy narrative, isn't it?
Purely. But let's look at the concrete operational steps that support this. We saw new investment in the Berlin gigafactory expansion. They're targeting 8 GWh annually from 2027. It's a huge investment, nearly 1 billion euros, all focused on increasing that critical cell production capacity.
So we have the huge market cap, global expansion, and this AI narrative all boosting the price.
Right.
But the picture isn't without some significant wrinkles, right?
Absolutely. The regulatory environment is always a headwind for them.
So what's the latest?
Well, a California judge recently ruled that Tesla was engaged in deceptive marketing regarding autopilot and full self-driving.
Oh, wow.
They now have 90 days to change their advertising. And given that the stock is priced primarily on the future promise of full autonomy, any ruling like that
It could challenge the core narrative.
could potentially challenge the very core narrative the market is buying into.
That's a great point. It really speaks to the tension between the valuation and the reality on the ground.
Let's talk numbers.
Yeah, the balance sheet looks phenomenal. Low debt-to-equity ratio of 0.17 and a very strong quick ratio of 1.67.
Which signals an excellent ability to cover short-term liabilities. They are financially sound, but their valuation metrics, they're almost beyond comprehension for a vehicle manufacturer.
They are extreme, and that's the whole story here, isn't it?
It really is. The trailing price-to-earnings ratio is 327.
327.
0.3. I mean, to put that into perspective, most traditional auto giants trade under a PE of 15. 1.5.
And the price to sales is what, 17?
17.4. So for every single dollar of revenue Tesla brings in, the market values the company at $17.
It's pricing in years, if not decades, of hypergrowth that has to be delivered.
It has to be.
It's also worth noting the insider sentiment here. While we see some small sales by other execs back in September, CEO Elon Musk executed a massive purchase.
A huge purchase. Over 2.5 million shares, valued near $1 billion.
At a cost of $389 a share. It's hard to bet against the person steering the ship when he's putting that much of his own money on the line.
It is. Now, diving into the charts, the technical momentum is just undeniable.
The stock closed just above its 52-week high.
And if you look at the 14-day Relative Strength Index, or RSI, it's sitting high at 68.95.
And the RSI measures momentum, so anything approaching 70 suggests the stock is moving fast, maybe even getting a little overbought.
It's approaching that overbought threshold, suggesting very high velocity. And the trend confirmation is crystal clear.
The simple moving averages, the SMA 20, 50, and 200, are all showing strong positive performance.
Think of the moving averages like a fleet of ships. When the short, medium, and long-term shifts are all pointing in the same upward direction, it confirms a significant bull run.
So for technical triggers, since the stock is already above its 52-week high,
That buy trigger has been fired. It's gone. If you're waiting for a better entry point, a pullback or, a consolidation near the SMA 20 might be an opportunity.
and on the flip side,
Conversely, if the stock rejects this record high and reverses, that would signal a profit-taking sell trigger.
okay, let's run the pure math breakdown. If you had invested $5,000 in Tesla about 3 months ago,
Based on the quarterly performance figure of 15.3%.
that $5,000 investment would now be valued at $5,751.50.
Netting you a paper profit of $751.50, a very solid quarterly return.
But, and it's a big but, that was driven by an already highly valued stock accelerating even further.
That's the growth narrative.
Now we shift gears completely. We're moving from the mega cap tech darling to the legacy value play. Ford Motor Company, ticker F.
And Ford is the story of strategic humility and a massive U-turn. They are a traditional S&P 500 powerhouse with a market cap of $54 billion.
Just orders of magnitude smaller than Tesla.
Right. And the headline news tells the story. Ford canceled the large F-150 Lightning EV project and subsequently took a colossal $19.5 billion EV-related charge.
That $19.5 billion charge is maybe the most expensive lesson in the history of the U.S. auto transition.
It might be. It's Ford admitting that the initial high-cost, high-volume EV strategy it failed.
So their new focus is on hybrids, affordable EVs, traditional trucks, and this new battery storage business. They're recalibrating to the reality of the consumer market.
And investors are now treating Ford like a classic value stock. The contrast with Tesla's valuation is just stunning.
What are we looking at for PE?
Ford's PE ratio is 11.72, and their forward PE is only 9.14. The price-to-sales ratio is a minuscule 0.29.
That just screams high-value proposition. It's priced far closer to a traditional asset than hypergrowth.
And the financial benefit for investors is immediate income. Ford offers a dividend yield of nearly 5%.
Which provides a steady cash flow that Tesla simply does not.
Exactly. Now, we do have to address their high debt-to-equity ratio of 3.47.
Right, that number looks scary on its own.
It would be terrifying for a pure tech company. But for Ford, much of that debt is typical and manageable because it's directly offset by their massive financial services arm, Ford Credit.
Which basically acts as a bank for car buyers.
It does, and overall profitability is sound with a return on equity of 10.26%.
Looking at the charts, Ford is showing positive momentum that seems to reflect market approval of this whole pivot. The stock is up over 40% year to date.
And the quarterly performance was strong. We also saw operational shifts like the Louisville assembly plant halting production for an extended retooling for their new EV line.
Okay, so technically, where does it stand?
Technically, the stock is currently only about 2% away from its 52-week high of $13.97. The RSI is strong, mid-range at 62. All key moving averages are positive.
That stability seems to indicate the market views that massive charge as a necessary cleanup before a strategic relaunch.
I think that's right. So a clear buy trigger here would be a sustained breakout above that $13.97 52-week high.
Which would confirm the market is fully confident in the hybrid pivot.
Exactly. And conversely, a drop below the SMA 50, which sits around 1284, would signal a rejection of this recent momentum, a strong sell or stop trigger.
Okay, so let's look at the numbers for Ford. Over the last quarter, its performance was 17.24%.
17.24.
Wait, so Ford, the legacy value play, actually delivered a better paper return this quarter than Tesla?
It did.
That completely flies in the face of the explosive growth narrative we hear so often.
It does. A $5,000 investment would have grown to $5,862.
Resulting in a paper profit of $862. That's a powerful illustration of how a value stock executing a successful transition can, well, unexpectedly outperform.
It absolutely is. And now we move to the middle ground. The high-risk, pure EV player Rivian Automotive, ticker RIVN.
The newer entrant, betting heavily on design and software to compete in the shadows of the giants.
And Rivian is defined by volatility. Its beta sits at 1.77, so it's highly sensitive to overall market movements.
The big news recently was their Autonomy and AI Day, where they unveiled a custom in-house AI chip and a $2,500 self-driving upgrade?
Correct. The autonomy plus Elling. It's a direct attempt to adopt Tesla's playbook and pivot toward being a software company first.
But the volatility is real. I mean, despite that AI hype, which initially surged the stock, it closed recently down over 4% on the day.
And they received a significant downgrade from Morgan Stanley to underweight with a $12 price target.
And there was a recall too, right?
Compounding this, yes, a significant recall of over 34,000 vehicles for a seatbelt issue in early December. The market's skepticism is palpable.
That skepticism is reflected in the high short float, isn't it?
Precisely. The short float is extremely high at 18.62%. This shows widespread doubt about their viability.
But it also means that any good news can trigger something else.
A massive short squeeze, where short sellers rush to cover their bets, which just accelerates the stock price dramatically.
The financial picture confirms the risk. RIVN is highly unprofitable, reporting a net income loss of $3.58 billion.
And a deeply negative ROE. The PE ratio is NA, not applicable.
So given those losses, how can they even sustain operations?
They have a robust liquidity runway. Their current ratio is 2.71 and the quick ratio is 2.23. This confirms they have significant cash on hand.
They can keep burning capital while attempting to scale production and deliver on those AI promises.
That's the bet. And diving into the charts, the last quarter showed a remarkable recovery.
Which suggests the AI news, coupled with that high short interest, fueled a spectacular rally from their 52-week low.
It did. The price is currently well above all three key moving averages, the SMA 20, 50, and 200, indicating a strong short to medium-term bullish trend is in effect.
And it's not too far from its high.
They are currently about 8.5% away from their 52-week high of $19.60.
So our technical triggers, a clean break and a sustain above that 1960 previous high would be a pretty strong signal then.
A very strong buy trigger, confirming the market's enthusiasm for the new strategy. A drop below the SMA 50, however,
would suggest the speculative run-up is exhausted.
And would signal a major sell trigger.
Okay, now for the final money math. Despite the lack of profitability, RIVN's performance in the last quarter was actually the highest of the three.
26.86%.
So a $5,000 investment in RIVN 3 months ago would now be valued at $6,343.
Yielding a paper profit of $1,343, the highest percentage gain.
Which really demonstrates the significant reward available in these volatile high-beta stocks when market momentum and maybe a short squeeze kicks in.
So synthesizing all this data, it provides a really clear snapshot of the auto sector's transformation.
It's all framed by these three distinct investment theses.
You have Tesla, the growth thesis, a technology company valued far beyond traditional metrics, riding that AI wave.
Then you have Ford, the value thesis, profitable, dividend-paying, and executing a strategic pivot away from the initial costly pure EV race.
Toward more sustainable hybrid and truck production.
And finally, RIVN, the speculative thesis, still deeply unprofitable, but with a strong technical rebound.
Fueled by high short interest and a deliberate bet on becoming an in-house software and autonomy player to compete with Tesla.
So tallying up our paper portfolio, a $5,000 investment in each, a total initial investment of $15,000.
Tesla added $751.50.
And RIVN topped the list with $1,343.
That brings the total paper profit to $2,956.50.
An impressive total portfolio return of approximately 19.7% in a single quarter. And what's fascinating is that the largest return came from the least profitable, most volatile company in the group.
It just reinforces the high-risk, high-reward nature of this sector's newer players.
For me, the biggest takeaway here, demonstrated by Ford's massive $19.5 billion charge, is the unmistakable recognition across the legacy industry that the EV transition is structurally challenging.
And it's forcing a major shift toward affordability and hybrids.
Right.
Which really raises an important question for you to consider. Given Tesla's astronomical valuation, which is supported primarily by projections of robotaxi fleets and AI, and you contrast that with the real-world operational challenges we see in the data.
Like Ford's strategic retreat and Rivian's continued losses.
Exactly. How much of the auto sector's future valuation is now purely tethered to software, autonomy, and technology promises, rather than the traditional manufacture and sale of physical vehicles?
That's definitely something to mull over as you digest this snapshot of a really shifting landscape. We hope this analysis helps guide your thinking.
Until next time.